And the reason they don't want to is because their bosses get paid on the amount of assets under management, not on the income produced for their clients. And that's the big fallacy in the advisory world today. They talk about being fiduciaries, but the only fiduciary interest they are considering is their own.
Welcome to the Bricks and Banks podcast, where real estate meets real wealth. Whether you're building from the ground up or stacking your paper to the ceiling, Steph breaks down property power plays and money moves you can act on. From first-time buyers to seasoned investors, this podcast is your blueprint for financial freedom through property, investment, and business. Subscribe now. It's time to build your future. This is Bricks and Banks with Steph.
Yes, we are live. Hey, everyone. Welcome to another amazing episode of Bricks and Banks with Steph. I'm your host, Stephanie, and today I have Steve Selengut joining us all the way from the US. He is a private income independence coach, an investment portfolio consultant, and I would say he's a wealth mentor. Steve, it's lovely to meet you. Thanks for joining us today on the pod.
It's a pleasure. Pleasure to be with you, Stephanie.
Yeah, I'm joining you all the way from United Kingdom, London. So where are you joining us from? Yeah.
I'm in Charleston, South Carolina.
Oh wow,
Almost,
that's nice.
Yeah, a little south of you, right across the big.
That's nice. I feel like it's quite warm there because here in London the weather has changed. Last week the weather was good, but today the weather is just off. Yesterday the weather was actually good, but today
I
the
think
weather is back to the gloomy UK vibe.
we're pretty much in the 80s every day. And then next month we'll start reaching the 90s occasionally.
Okay.
It's hot in the south, but we're
I think
right near the ocean, so it's a little cooler than further
okay. Than the
inland.
other places.
We get plenty of wind and breeze, so it's not a bad place at all.
Amazing. So I titled this episode The Income Coach. The focus is on you, Steve, today, and we are delving on how Steve Selengut built a portfolio that thrives in every market. You need to let us in on your secrets. So let's get to meet you. I feel like you've lived like multiple lives. So can you pick one from your
at this age, it's the same as living multiple lives.
You've lived like multiple lives like you. You're like, okay, let me give her this card today. So which card are you pulling out for us today?
Well, I've had a few different. This is let's say my third career.
Wow.
I started off with an insurance company in New York, and then in 1979, when I was 34, I had already started my own investment portfolio, and it was an income focused portfolio back then, and I was making significantly more with my investments than I was with my job. And my job entailed getting on a bus at about before 6 o'clock in the morning, and then to Manhattan, and then walking up 10 blocks to my office building and doing the same thing at night. And I was spending roughly 4 hours a day commuting and 8 hours at the office. And for what? I wasn't. It wasn't a good job. So I said, well,
it wasn't hitting the bottom line.
It wasn't reaching my bottom line, that's for sure. But I knew that I could make as much money for other people as I was for myself if they let me. And I could show them how my portfolio had grown from when I started it in 1970 to 1979 and how much income it produces. And it was really kind of easy to get the first two customers, first two friends of mine to sign up. And so I did all the additional stuff to get my licenses and things like that. And I found a brokerage firm that I could team up with.
Okay.
And I started the business in 79. And,
Wow.
And I sold it. That was my first career. I was managing money for other people. And we grew that business to the point where we had about 150 clients and
Wow.
about 110 million under management. And I was the only manager, so I was managing all of it. And we sold that in 2023 for, if you're familiar with The Godfather, it was for an offer I couldn't refuse, it's like that. And then I wrote Retirement Money Secrets, which I don't know if you've seen it or read it or not, but
I haven't
it's
seen. I
certainly
think
available
I
there
must.
in the UK.
Okay. I
And
think
I
on
wrote,
Amazon. I'll be able to check it out on Amazon, right?
yeah, yeah, it's there. And I wrote that, and I started a management, or not a coaching career. And the first year was really quite successful.
Yeah,
This past,
you have your work to speak for you. So of course people would want to learn from you and
well,
find out how you grew that
hopefully,
business.
well, it's a different approach. It's
Hmm.
most people, and we'll get into that probably in the discussion, but the focus of most investment plans and investment programs is not the generation of income. It's the creation of market value.
Sure.
And there's a big difference in that mindset.
Hmm.
So my latest gig, if you will, is in December. We created a income investing community, and it's an educational community, and we're creating a course of study, just like a graduate degree, just like a graduate program. Of course, it's not sanctioned by any educational institution, but it's ours, and it's going to have about 12 different sections, and it's all made up of individual hour type question Q&As between myself and the people in the community. And the textbook, of course, is Retirement Money Secrets. Everybody's got to read that before they can join the community. And then we have weekly Q&A sessions and stuff like that, and private chats, whatever we want to do. And I do some coaching as well.
Nice. So the coaching you do aside that is like one-on-one private coaching.
One-on-one private coaching,
Okay.
and the community is, group collaborative coaching, answering questions. And of course, you get people who just joined the community yesterday, and they're asking the same questions you've been asked for the last 4 months by other people. So you get the others to pitch in and help them. And then we set up a separate thread for beginners who are just starting with the program. So that's helpful too. So it's a good group of people.
Amazing.
It's over about 400, almost 460 people in it right now. So it's growing.
I love the fact that you're not just making money, you're sharing your life, you're sharing that knowledge with a lot of
Well, yeah,
people. Yeah, because you're sharing your life's work really, and that's the best way to give back. Yes, you're going to get paid for your time, but you're inadvertently sharing your life's work with other people who go on to share that same knowledge with the rest
well,
of the world.
hopefully, and hopefully it'll be enough people who are thinking about income eventually that the Wall Street big shots will say, "Hey, this is a trend or something. This is important. We can do." They certainly. I'm using Wall Street products.
Yeah.
They can certainly focus their attention more on income, particularly to old people like me, than they are to market value, which pays no income.
Yeah, I like the fact that you're very focused on the bottom line. But let us backtrack a bit to your background. Was this what you studied in school? Did you study investment in school? Or how was your childhood growing up like?
Well,
Can you share that story?
my childhood was in a successful businessman's family, and he had in his real estate uh, um enterprise, he had developed multiple sources of income. He had rents. He had sales of real estate and sales. He built houses. He had a lumberyard that provided all the building materials to not just his contractors, but all the contractors in the area. There were no Walmarts or Lowe's in those days. Just individual type businesses going on. He provided insurances for his rental and homeowner customers, and he actually provided mortgage money for many of the people who bought from him. So he had 5 different streams of income. So if there was a bad real estate market, people were still paying rents, people were still shopping at the lumber yard, still paying their insurance programs, and still paying their mortgages. So the money was always flowing in. So that was kind of the environment that got me started, and it made me start thinking of different ways to generate income while I was still working in New York. So I had this portfolio, and all the stocks that were in it were dividend paying, and I traded them. I had target profits, and if a thing went up 10%, I sold it and I bought another one. And my broker and I developed a universe of stocks that were rated B+ or better by Standard & Poor's. They were profitable companies. They paid dividends. They had multiple channels of business. They were not just one-show ponies. They had broad, diversified operations. And there was always something to buy. There was always something to buy up until the end of the financial crisis in 2010. From that point on, nothing at the high quality level went down enough that I would consider buying it. So I switched from that form of equity investing to the form that I use now, which is a thing called closed-end funds. And these are pass-through trusts, and you must have them in Great Britain as well, where you set up a trust, and the trust itself has a business or whatever. It's not taxed because it passes all the money back to the people who are receiving the money from the trust. And that's what these are. So these closed-end funds are in the business of making money that they pay to their shareholders, instead of the normal Wall Street where they're making money to pay to their owners, CEOs, their big chief executives. So it's a whole different way of owning all the stocks you can own, and also all the bonds and mortgages and real estate and other types of income-focused securities in an income-focused operation instead of a market value-focused operation.
Okay, so when you talked about your childhood, how you grew up in this, you were exposed to the economy of multiple streams at a very young age. Was this like a family member, or was this just a random person you went to work with? And did that?
My father.
Oh yeah.
Was the developer.
Nice.
And as children, we received many of the benefits of his multiple streams of income. So it was something that, as a youngster, you kind of get used to it. Sure. So you might say I was a privileged soul.
You're born with a silver spoon.
I was pretty lucky.
Yeah, that's a good start.
When I got out of school and I got my first job, and then I was charged with the responsibility of managing these assets. I mean, I wasn't about to take any risks that would lose them. I studied the companies that I owned. I looked at the charts, and I realized that it was up and down, supply and demand marketplace. Some of them paid dividends, some of them didn't. Some of them were profitable, some of them weren't. So I geared my stuff to the safe side of the street. I wasn't going to take any undue risks with a company that hadn't made its first profit yet. I wasn't going to buy that kind of thing. I was going to buy, of course, it was Esso at the time, and I was going to buy Pfizer, and I was going to buy, that type of company that was well known, well respected, hopefully globally involved, or that they weren't as much global involvement in those days as there is today. But that's where it all started.
Did that shape the type of course you studied in the university, or you just studied?
Well, I was a business major. I still have up here somewhere a textbook that says investments on the back side of it. At least I used to have one up there. So I still have, I did my homework. I knew about statistics. You took statistics course, so you know how to look at numbers
Yeah.
a little bit. I'm not a tech guy when it comes to investing. I'm more fundamentals.
Yeah.
Profits, PE ratio, things
The
like that.
EBITDA, the bottom
Yeah,
line.
I don't pretend to be able to predict the future from the past. That's what most technical analysis is telling you it can do. It can't.
Yeah.
Not in my opinion, it can't anyway. So I was a pretty conservative starting point investor, and I've never seen the need to take big risks. When I started managing money for other people, I told them I'm going to run your portfolio in the same way I run mine, and I will never ever put you in any kind of investment that I don't own myself. If I don't own it, you're not going to own it. And I still do that today. In this, we have a universe of closed-end funds that we use as the basis of our research in the community I manage. And I own every one of the securities on that universe. I've always stood, I'm not going to put anything out there that I own myself.
Yeah, I love the way you practice what you preach. You're not just telling people what to do. You're also doing it and leading by example.
I think they have a right to expect that, and I think most people understand that in the normal world of investing, that's not what they get. They're getting the products that the institutions are telling their employees to push to their customers. Back in when I started, they used to call it the stock of the day. The boss would get all the brokers over in the corner of the office at the beginning of the day, and they say, "Okay, word just came down from headquarters that this IPO they're pushing. You got to get out there and sell it to your client." And that's what they would do.
Did you ever walk on Wall Street?
I have walked on Wall Street, yes.
Nice.
I've never been inside the exchange in all those years. In all those years, I've still never been there. I stood outside and said, this is the place. But I've never been there.
Okay. So what motivated you from active investment management to coaching? Like, what was the tick for you that made you like, okay, I'm going to sell up this company and I'm just going to do full-time coaching?
They made us an offer we couldn't refuse. I was 78 years old.
Oh, wow. How old are you now? You don't look. I could guess that you were like 70. I didn't know you were 78.
Yeah.
When you sold off.
I was 80. I became 80 less than a month ago.
Oh wow. You do not look. I would have guessed you were 70 right now. Yeah.
Well, thank you. So anyway, when you get to be that age and somebody says to you, "This is what we will pay you for your business, for your share of this bigger business," that was the equivalent of 6 years' income. Of course, you don't get it all at once with these people. They give you just a little more than half, and then you have to make sure that the old customer, you don't try to take the old customers, and you have to have the non-compete and all that stuff. So you get about half of it. And since I had enough of a portfolio that took care of my needs, my income was outside of my management was, probably about 60% of what I was making managing $110 million. And the numbers, that's not a bad sum of money. And with the addition, I was almost making as much as I was making before anyway. So it wasn't a hard thing to wait the year for the next almost half and then another couple months for the final thing. So it took a total of about 16 months to get all the money.
Oh, okay.
But still, it was enough, and I already had, that's the magic of creating an income-focused investment portfolio. It can get you in a position where you can quit your job or sell your business, and the money is still coming in. while you figure out what you're going to do next. So I didn't have any trouble or any financial problems setting up a whole nother business and starting an LLC to be the income coach and things like that. It was a piece of cake.
Did you have to set up a new team, or were you allowed to take members from your previous team?
I didn't have any. The only member from my previous team is the young lady that was sitting over behind you just a while ago. And we didn't, most of the, all the back office stuff was done by the brokerage firm, by the firm you trade through called the broker dealer. And they'd take everything statements and everything. And that's really good because it's a separate custodian relationship that actually takes care of the client's funds. They never were in my hands. The manager like myself or even the broker could not actually access the money, for their own purposes. So it was a safety net really for the client to have it with a separate custodian.
Okay. So let's talk about how you do business in terms of investment management. So why do you believe that the widely accepted 4% withdrawal rule is flawed? And how do you consistently generate an annual nearly 12% income?
Well, it's 12% income is really pretty easy right now because of the increase from 0% basically 2 years ago, right?
Okay.
To 5% where it is now.
Yeah.
It caused, and you know about interest rate sensitivity.
Yes.
Right? When interest rates go up, prices go down of interest rate sensitive securities. So when that vast increase, and nowhere in history have interest rates gone up 5 percentage points that quickly. And 5%, although it's really not a very high interest rate, people think of it as a high interest rate today because they didn't live back in the 60s and the 70s and the 80s and even the 90s when low interest rates were 5%. Now it's 5%, as high as percent. Rapid rise in interest rates caused interest rate sensitive securities like closed-end funds to go down a whole lot. But they don't stop paying their income because the securities they contain are still paying, mortgages continue to pay. Bonds continue to pay. It doesn't matter which way the prices go. Okay. Even when their prices fall because interest rates go up, that coupon is still good every 6 months. And they're still good. And they're going to still mature at face value. But now you can buy them when interest rates go up. The recent ones, the ones that are paying less than 5%, more than 5%, you can buy them at a discount, so it's easy to understand if you have the right background why interest rates going up and down are both good and bad. 5% interest rates are terrible for the run-of-the-mill retired person who's depending on a bank account, savings account to produce income for him. Okay. That's why so many people during that 12-year period had to swarm into the stock market because they couldn't get the returns they needed. And Wall Street told them, oh, you have to get in the stock market. That's the only place you can get a decent amount of money on your investments. And that's what happened. So that's basically it. That's what,
Let us talk about the market cycle investment management, MCIM. Can you walk us through your MCIM strategy and how it protects income even in volatile market situations?
Yeah, well, way back when I first started investing, before I even started my business, when I studied the patterns of the IBMs and the GEs, and you notice that the market would always go up and down. It would be usually a higher high and a higher low, but it was always fluctuating. And and so I used to set my sights on on individual securities. When they went down when these elite group investment grade value stocks that I looked at, when they went down 20%, I'd buy them. And then I'd set a 10% target to sell them. And I had about 225 companies in this index I had that somebody else ran for us. But there's always stuff to buy and sell. You noticed that each sector has like a cycle as well.
Okay.
Recently, we've had healthcare stocks have all gone down because of the,
Yes.
what's going on in the U.S. again. So same thing with oil when there's war in the Middle East, as there pretty much always has been in my lifetime. If it's depending on how bad it is, the oil prices will go up and down, right?
Yes.
And the price of the oil companies would go up. It's the same type. There's so many different sectors. So if you visualize that, and then you can break it down to, okay, there's the stock market cycle, which is pretty close. And then there's the interest rate cycle. What happens when interest rates are trending up or down? When they're trending up, as we discussed, prices are going down. But the cycle is a much longer, typically it takes many more years for interest rates to go through a cycle than for the stock market. So you have two different cycles to look at. So when you're looking at your equity portfolio, all you have to do is look at the trend line of the S&P or the Dow or the NASDAQ, depending on where you're buying. In the case of closed-end funds, you can just look at any one of them, and you can see. You look at the S&P or the Dow, and you can see where you are in the cycle. It's very clear when the market's been down. It's down there, like in the Great Recession, it went bam like that, and everything you look at has that type of situation. Okay, so you can tell when you're down, you can tell when you're up. You can't tell where you're going. I know a lot of people want you to believe that they can tell you where it's going because of where it's been in the past. Not true. Not true. It's just like human beings. You can predict behavior of a human being a little bit better than the stock market, but it's still not 100%. Anyhow, so if you're at the top of the stock market and you've just sold something and taken your profit, when you reinvest that equity money, instead of buying your normal amount that you would buy, let's say you start a position at $6,000. If you see the stock market's at or near an all-time high, instead of making your initial position $6,000, you make it $3,500, depending on just how high it is. But at an all-time high, maybe you only start with $3,000.
Okay.
Because you know that eventually the market's going to go back down again. You don't know when, but when it does, you can then add to that position. So you reduce the average cost and you increase the yield at the same time. Now, in closed-end funds, you're doing it with a portfolio of hundreds of stocks. So you're buying, when the market's high, you buy half your normal position. And when the market goes down, you add to that position. I finally got around to answer your question. Closed-end funds the only thing they're trying to do is generate income. And they'll do that by dividends they receive from the stocks, writing covered calls, selling them for profits. Now, and unlike a normal company or business, they're not going out to reinvest in new locations or hire more people or bring on more salesmen. They're just taking that money and handing it to me, the shareholder. 95% of the money they make in a pass-through trust has to move to the shareholders. Okay, now can you imagine if Amazon and Microsoft and all those companies had to pay out 95%?
They'll be out of business in no time.
So there you go. So that's the difference. So the market cycle management is knowing where you are and adjusting your behavior to that. When the market's at a very real high level, you don't raise your profit expectation, because in the back of your head, eventually something's going to happen. Planes are going to fly into office buildings. Somebody's going to drop a bomb on somebody else. Something always happens to bring the market down. So you take that profit. You don't say, oh no, it's going up forever, I'm going to just hang on. You take the profit and you reinvest, like I said, in a lower amount of stock, move some of it into the safer type of securities in your portfolio, the income. Same thing goes for the income securities. Where are we in the income cycle? Right now, we're actually very low in the income security cycle because their prices have been pushed down since interest rates started to go up. The prices back in 2020, back then, were much, much higher because interest rates were near zero.
Yeah.
Okay. So when you look at it on a chart, you'll see today's price for this particular income CEF, which is yielding 12%. And you'll see back then, just 5 years ago, it was a mountain higher because interest. So it makes you think, geez, when interest rates actually do start to go down even a little, the price of this one's going to come back up. So you can pretty much, in the income sector, you can pretty much buy all you want, right? Buy your normal amount because it's still down.
So what would you be like? What would be your top 3 stock picks for someone who is just starting invest?
I would tell them, and because I'm a professional investor, I'm not going to give I can't give any stock pick, okay? Because that wouldn't be right, because I'm supposed to be an expert and they could go out and sue me later. So I'm not going to give you a pick.
Okay.
But what I would tell you to do would be to use closed-end funds, first of all, as your vehicle, because it's a managed portfolio, well diversified over hundreds of different securities in most cases, and it pays a very secure and stable income. So I would go and I would buy some of those because it's instant diversification. But there's a place called CEF Connect, which lists all of the different things that are available, and you can put them in order by the amount of distribution they pay, by the amount of leverage they use, by how many securities they own, by who manages them. And they're all managed by people like BlackRock and Nuveen and and Eaton Vance, companies that are very famous all over the world. So it's a very secure way to go to make an initial investment. And that's what I would advise people to do, to look at those. If they're full of stocks, buy about 1/3 of what your normal position would be. If they're full of bonds, buy whatever your full position will be. And everybody's level of positions and how much to buy depends on how much money they have. Like an investor with $1 million to invest may have a starting position of $10,000. Whereas if you've got $100,000, you should be starting around between $2,000 and $3,000. So it varies by people. And of course, you can, if you want to join a community of safe closed-end fund investors, you can join this community that I manage, and you'll get lists of the securities that I own, the closed-end funds that I own, the universes of the various types that you can choose from.
Oh, so I know that do you focus a lot on retirees? Because a lot of them, you're like the personal coach for retirees. You're trying to help people make the most of their money in their retirement age. And for a lot of them, they fear market corrections. How are you reframing this mindset in your community, especially to help them see downturns as income growing opportunities?
Yeah, that's really the mainstream. I would say that of the 460 people in the community, I would say 80% of them, between 70 and 80% are retired, and many of them recently retired. And the key element there is the transition phase of moving from the old, what they probably had in their retirement program, managed or personally managed, doesn't matter. They probably had not the best diversification in the world, only 2% or 3% income coming in from the securities in their portfolio. So you need to sell them, move them out of one location, move them out of one sector to another, stuff like that, and bring them into CEFs. And that's the big part of the coaching and big part of the education. We've had Q&As just on transitioning from your existing portfolio to the new income-focused approach. So yeah, that's the key. But you also have the people, the young guys, these and 40-year-olds who have a successful business. Like you're going into this, you're going to develop this business and you're going to make big bucks,
Yes.
right? But you're focusing on your business. So somebody's got to run this portfolio for you. So you're going to tell that person, hey, because I just spoke to this guy, Steve, and he says I can make 7, 8, 10% on my money. I want you to take this money and manage it for me, and you better be making me income at that level, or else I'll find somebody else. So it's also for your generation of successful people who can put money away to manage it. And finally, it's for parents who want to get their youngsters and off to the right foot when they're out of college and stuff, because it shows them how to develop a portfolio of income. So they too will have the luxury that I did when I was 34 to say, I'm not going to work for this guy anymore. I'm going to do something on my own, and I can afford to wait to get that job because I got a lot of income coming in.
Okay, that makes sense.
So there's actually 3 types of people, and it generally includes almost anybody that's got money to invest. Should be focusing on income. And over the long haul, your portfolio is going to grow in market value too, because when the times when interest rates go down, your market value is going to shoot right up, and instead of being that happy about it, you can say, oh my God, I can't get 10% anymore. Now I'm only getting 8%. Back when interest rates were 0, the closed-end funds were paying between 7 and 8.5%, not an average of over 10% like they are today.
Okay. So what would you say is like the reasonable time frame for someone who gets into your community to like transform their portfolio journey? I know that investment is like it's playing a long game, but what's the average time frame you see people making tangible results in their portfolio after joining your community?
Yeah, the full transition. I used to transition people when I was managing other people's money. If I got, a $500,000 portfolio, I'd probably have it transitioned within 2 weeks or so.
Okay.
Okay. And again, you don't I'm not buying the same thing for everybody. It's selectively invested, and every person has their own
appetite,
how much they want to have, an appetite, asset allocation depending on age and risk, how much risk you feel you can handle, which dictates how much money you're going to have in the stock market. Because even though these equity closed-end funds are paying 10% and are very stable in their distributions, they're still riskier than mortgages and bonds and real estate, which is the other side of the house, the income side of the assets. So most of these people go really slow the first month or so, and I'll see they'll pick away and they'll say, okay, I got my first 30 different funds. Woo, shoo, and what do I look for now? And we keep telling them, well, you got to keep adding new position, because the more diversification you have, the more opportunities for profits you will have.
Okay, that makes sense.
And the safer your overall portfolio will be. So it takes them that once they get started, once they're into the first month will be slow. The next 3 months will be, just wham. They're in. When they see income hitting their accounts from the dividend, because now you're talking about monthly dividends instead of quarterly dividends in the stock market, and semi-annual interest payments like in the bond market. Now you're talking about monthly. Three quarters of the equity closed-end funds pay monthly, and the rest of them pay quarterly, and almost 100%. 95 or better of the income focused closed-end funds pay monthly.
Okay.
So it's really different, really different.
Nice.
So yeah, it doesn't take a whole long time to transition, but I would guess that most of the people scratch their head a little bit when they're first reading the book and say, wait a minute, I've been told total return is the most important thing, and you're telling me I can't spend total return. Well, you can't spend it until you sell something, buddy. And the total return one year can be a negative total return the next. But if you're investing for income, your income's going to grow every year. Unless you spend more than you make, your capital and your income is going to grow every year. And a lot of people really like to hear that.
A lot of people get conflicted on when to buy and when they know when to buy, but they are conflicted on when to sell. So how do you advise people on when to sell stock? Because some people rather just hold on to that
Well,
stock
that's what they're told to do.
Yeah.
But if you're income focused, you have to understand that profit taking is a whole nother stream of income.
Okay.
For example, let's say every major like Fidelity, Schwab, and that like every month in your statement somewhere, you'll see an illustration that shows you what your anticipated monthly income is for the next 12 months. Okay. You can see that. And that's one of the things I focus on. I want to see that every quarter. I want to see that growing, that income. The only way that you're going to be assured of making income is to actually go after things that pay it regularly and that have a track record.
Okay. Most times when people always have the advice to buy the stock is going to do well, but no one says sell the stock at this point. So how do you advise people on knowing when to go into and when to come out of that position?
Sorry. The key is to have a target profit. You always set a target. Like I have a target. The way I express the target to people who are using closed-end funds. When I used to invest in stocks, I had a 10% net profit. But with closed-end funds, since you're thinking of portfolios of stocks, it's not reasonable to wait for 10% to see them all come up. It's not reasonable to wait at all, actually. So I say if it goes up, let's say we're in a rally situation, sell everything if it gets near 5% and find something to buy, and you just buy less of you just alter your normal initial investment if all the markets are high. But 5% is, you never hold on longer than 5% because you don't know when the ball is going to drop, when the next problem's going to happen, and the market gets tanked and you watch all this money disappear. I had a situation back in just before the financial crisis where the compliance officers of the company I was trading through was saying that we were trading too often, which didn't look good to the SEC, the Securities and Exchange Commission in the U.S. You're trading too often, which that used to be a problem. Remember, in the old days when it was commission-based and they'd think brokers were churning the accounts for commissions. But now there's no commission, so it doesn't make sense to even consider how often somebody's trading. But you're selling too often. It's not a good thing. It's not right. The SEC doesn't like that. So they made me agree to only sell at a 7% profit. Okay. And I said, this is total BS. It's not the way we run portfolios. These clients could sue us for not taking their profits because we told them we would be taking their profits. And I was just jumping up and down mad about this thing. But I went to it. And then you saw what happened in February and March. The market started to really go down bad with COVID. Yes. And then, of course, in March, it crashed and it stayed down through April. Not much. But during that period of time, I went from having 80% of my positions in the green to maybe none in the green. That's how much a correction changed things. All right. So I told my broker, I said, here's the deal. Here's the deal. And I want you to communicate this to the compliance officer, or I'm going to call him myself. I said, I want to see a check for $450,000. I'm sorry, for $4.5 million, because that's how much money my clients lost because you wouldn't allow me to take profit.
So what did they do? What was your response?
He said, yeah, right, I'm going to say that. It doesn't click with those people. It just doesn't click. When they bought up our company, they didn't care that we are providing more income for our clients than anybody else could possibly do or would possibly do. They didn't care about that. The only thing they cared about was you will keep that AUM or we're not going to pay you the rest of your money. Yeah, that's what they cared about. That's all they care about. So yeah, you set profits, and depending on where the market is, you set a percentage. When the market is down or crazy like it has been recently, any profit is a good profit, because if you don't have a lot of things at a profit, that means a lot of things are at lower prices and higher yields. So if you can scrape out a profit here, you can add it to something or buy something new that's paying a higher yield, or add it to something to reduce the cost and increase the yield. So I trade just like a department store would trade. I have all this merchandise in my shelves with little 3 and 4 letter symbols on my merchandise. And if somebody comes in and say, I want to buy that at your markup, and my markup right now is very low. If I can get 1%, I'll take it. So I'll take that. I'll sell them that merchandise, and I'll find another 3-letter piece of merchandise to put on my shelf. And I'll just do that until we get a situation where everything is up 1%. And then I'll go to 2%. Then I'll go to 3%, 4%, and then 5% is my limit.
Okay.
Only once did I change that limit, and that was in 2021.
When the market was
And then
recovering.
I did. It was just so. We were making $30,000 in profits a day on the managed portfolios, and we couldn't just keep up with the reinvestment and interest, and the money market funds were paying 0.
Yeah.
So you didn't want to have a huge amount of money in cash because it wasn't working, and you just didn't have the time to reinvest all that money every day. So we went to 6%. So, oh well.
I know one of your favorite quotes from your website says, market value fuels the ego, income fuels the yacht. So I want you to break down this for our listeners. What essentially fuels the yacht? Is it the market value or the realized income at this point?
Well, the market value for most people, they feel wealthy when their portfolio account statements are at an all-time high or growing. I've got all this money. I'm so rich. I've got my portfolio is worth $1 million, but that portfolio's generating 3% income. So the portfolio grows. Now it's $2 million. I got $2 million. Now that percentage is half that, right? Because it's the same income, but now it's only 1.5%, 1 to 1.5% it's paying. So if he were to take that million, the last million, and reinvest it in stuff that's paying 8 or 9, 10% right now, he would now have a $2 million portfolio that's generating 5 or 6%, right? Because the first million wasn't paying anything, and this one's now paying 10%. So, right, you're the math person. So it'd be about 5. Now he's paying 5%, and he still has $2 million in capital, right? After selling that last $1 million. So people don't see that. They don't see the difference. And then let's say the following day, after he's sold it, after he's reinvested, and he's now got this $50,000 in income. No, it's $2 million. It's $100,000 of income coming in. Then we have a market crash. His market value goes right back down to $1 million. He's still getting $50,000 in income.
Yes, income that matters.
And right, because the income's still coming, and he can reinvest it at lower prices, and now instead of getting 10%, he's getting 12%. So that's the way you have to look at it. You have to look at the cash flow. That's what's going to be paying your bills. That $50,000 is going to do a whole lot for him in paying his rent and buying his next vacation than the $20,000 or $2,000 he was getting before that.
Okay, nice. That makes sense. And I like the way you put it in your book when you talk about the working capital model. Can you explain what is the core principle behind that working capital model, and how can a DIY investor apply it in their portfolio today?
Okay, well, working capital is the actual amount you've invested in a particular security. So if you look at your statement, you see you have 30 different securities, and you have the current market value, and then there's another column that says the cost basis. So if you add up the cost basis and you add the cash that you haven't spent yet, that's your total working capital. It's that investment amount that produces the income. The market value is going to change every minute of every day. The income and the cost basis are going to remain the same unless you add to them or buy or sell them or whatever. So the way if market value just grows and you don't sell anything, the working capital remains the same. If market value, let's say, goes up 10% because a handful of securities has gone up a lot, and you sell those securities and you capture that 10% capital gain, you're growing capital. When you reinvest it, you now have that much more working capital that's invested to produce more income. So by doing that, you grow your capital and you grow your income with every transaction. Working capital grows by depositing money to your account, by having dividends and interest come into your account, and by taking profits in your portfolio. Working capital only goes down if you take losses or if you spend money.
Nice.
It doesn't go down with changes of the market value. Right. So, but in order for the working capital model to work, you've got to have some disciplined rules on the types of securities you buy, because you can't be speculating and just hold on to something if it goes down in price. If you're speculating, typically it's not paying any dividends, so you wouldn't buy it in the first place. But let's say you have a speculative holding in BDC, which pays a lot of income, but it's still speculative because it's investing in a marginal company that's not doing well, and they're trying to make it become successful. So it's a big risky venture. It's still paying investors money to get their money into the thing. So you have to have strict rules. So you have what I call the QDI plus PT. You have to have rules on the quality of things you buy if you want the working capital model to work. You have to have high quality only securities. They all have to be income producing, and the portfolio has to be well diversified. So you have to have things in all sectors, including global markets. Okay, all types of investing. You have to have an income bucket of at least 40%, and a 60% equity bucket. If you're young, if you're old, you have to have at least 65% in the income side and 35% in the equity side. That's what I have right now in my portfolio.
So when you talk about the income side, are you referring to bonds or bonds?
Bonds, preferred stocks, mortgages, various types of real estate investing, loans, liens, BDCs, CLOs, that's collateralized loan obligation. But those are in the form of ETFs or CEFs because they're still diversified portfolios of those type of riskier securities. REITs are in those closed-end funds, and some master limited partnerships as well.
Okay. Do you ever do?
So there's a lot.
Do you ever do anything with crypto or no?
Never. There is a new ETF out that's paying a large income that invests in crypto, but I always tell people don't invest in anything that you don't really understand. And I have no clue what crypto is all about, and I'm not really interested in finding out. No, crypto hasn't. I've never done any crypto. And if you have marginal wealth, think about crypto just like you would about a trip to Las Vegas.
And did you ever
Not something.
one?
If you've got, I had a coaching client right after I started coaching, and he was a big operator. He was like an angel investor to other companies, and he had a big portfolio, which I was helping his executive that dealt with his portfolio, transition to to closed-end funds. And he also on the side had a crypto portfolio. And I told the guy I was working with, I said, I'm not going to be able to help you with anything with that portfolio, except to show you when you see how much you're making on this portfolio, I'm sure your boss is going to tell you that crypto portfolio isn't worth the risk. Do what you're doing. And that's pretty much what happened. So yeah, it's just a speculation to me at this point.
Yeah. So in your experience, what are the most common mistakes people make when they're preparing for retirement, and how can they fix them?
When they're preparing for
Yeah.
retirement, they just don't spend enough time coming up with or insisting upon the advisor producing more income for them. They've been coached and taught that this market value, we're going to manage, the market always goes up eventually. So we're going to manage this portfolio so you always have, your market value is going to be growing, or even if it's not, we're going to take this 4% out of, we're going to sell your losers. The ones that aren't going up, we're going to sell. And that's how we're going to provide you with your monthly expenses. And that's pretty much what they've grown up with, this idea, this 4% rule, as they call it. And I think 4% is a pretty good target number. 4%, you could probably take care of all your expenses in retirement. Particularly if you weren't paying somebody 1.5% to manage it for you.
Definitely.
So if you got a
you're doing it
manager,
yourself,
then it's got to be, then you're going to be paying over 5% a year. But you're reducing your capital base. And I think a lot of people would like to turn over their $2 million 401k or IRA to their kids, or do something with it, or donate it even. But instead, they're taking losses, reducing the capital, reducing the income it produces, and draining that. So when we get a market, like today, the stock market is below where it was in December. It's below, I think one of them is as far back as last July or August. So when nothing's going up, that means every bit of that 4 or 5% means you're selling stuff just to pay your expenses. You don't have to do that, because any investment advisor, whether he uses closed-end funds like I do or not, there are mutual funds that pay more than 5%. There are ETFs that pay as much as 10 or 12%.
15%, some of
There
them.
are CLOs, there are REITs, there are master limited partnerships, there are 100 dividend stocks that pay more than 4%. So not being able to guarantee you, they can't say guarantee, not being able to have you confident that your portfolio will produce at least 4% is total baloney. They can do it if they want to, but we all know why they don't want to. And the reason they don't want to is because their bosses get paid on the amount of assets under management, not on the income produced for their client. And that's the big fallacy in the advisory world today. They talk about being fiduciaries, but the only fiduciary interest they are considering is their own.
So at what age range do you think people should start prepping for retirement? Because I feel like it always hits them like a bucket when they are retiring from their jobs. So what's the age range people should actively start prepping for retirement?
Well, I wasn't thinking of it as retirement, but I was thinking of income. I think income changes your life. If you have a job that's paying you just enough to get by, and you get an inheritance of $100,000, you can produce another $10,000 of income with that inheritance, which will change your life. You won't be living paycheck to paycheck anymore. Even if you're making 8,000 or so, or 800, 900 a month, whatever it is, at least you got that much more to spend. Or you can just keep it investing. So what I did, I was 25 and I had my portfolio and I was growing it to grow the income so that I could eventually get out of that job in Manhattan and start my own business. And that's what I did. If you just have a bunch of dollars sitting in a bank or a bunch of dollars in a portfolio that's not paying any income, then in order to take that step, you've got to sell it so that it finances you while you're waiting for that next career. So I think your portfolio at that time should be focused, let's say 60% in the stock market and 40% for income. But if your stock market investments are paying you 10% like they are in CEFs, you own the same stock. You own the NVIDIAs and the Amazons. You own the same stuff, but it's in an environment that pays you money. And it's less speculative because it's not there to grow the market value. It's there to grow the income. So I think an income focus comes as you get older, but having an income generating portfolio while you're younger makes as much sense because it will help you make the strategic changes you want to make during your life to improve your status, to improve your job, to improve everything.
Yeah, and I know a lot of people would say one of the biggest
money fuels the yacht, even a rowboat.
Definitely. I know a lot of people would say real estate is one of the best vehicles to an income producing asset. What's your take on that, and how can people leverage real estate, not just REITs in this case, but the real estate itself, the equity?
Well, real estate is interesting because you don't really, unless you have income, you can't just be a developer. You have to borrow money. And unless you have, most of the people who have their side gig or whatever, or they're real estate investors, they have rental properties. And the rental properties produce a stable income. Or they have, like my dad did, they play banker and loan people money and that. And I know that since talking to some of the people I've been on podcasts with that were in real estate, I've had some of them have that light bulb go off. You say, we ought to have an insurance broker in our firm to take care of that, and they've done that, so stuff like that. But, the real estate's a fine way to grow a portfolio, but you still, this is the same thing as I'm talking about. Just because the market value of a building goes down, that doesn't make you sell it and take a loss, right? It doesn't hurt you. If it's a rental property, the rent keeps coming in. You don't reduce the rent because the property value went down. They still pay the same amount of money. So it's a good parallel to the way that I invest in the stock market. The key difference in my mind is I don't get any phone calls in the middle of the night that the plumbing's not working, None of that's going on. I don't have to worry about the government raising taxes. I don't have income taxes, yes. Property taxes, no. I don't have the insurance issues on the securities. I don't have damage control on the tenants. There's a lot of stuff you don't have to worry about in the income focused retirement area as you do in the real estate investing area.
Nice.
I invest in a lot of real estate in the closed-end funds. That's how I do it.
So I know you are a private income independence coach. So what does income independence mean? Is it the same as financial freedom? And why should every investor aim for it?
Well, I think there's a difference between financial independence and income independence. Financial independence is that guy he's worth $10 million and he's got things in different places and stuff like that. But if he's got a year where he doesn't get, for some reason, all his stuff isn't paying enough income for him to do what he wants to do, he's got to sell something to do it. He's got to sell something maybe to pay for some serious medical emergency in his family. Okay. He's got to pay for his kid to go to graduate school or his grandkid to go to graduate school, and he doesn't have that much enough cash flow to do that because it's all tied up in other businesses and this thing. Even though he's a very wealthy guy, he just doesn't have the income to take care of something he needs to take care of. He has to sell something. On the other hand, with a lot less money, with a lot less wealth, you can be income independent if you have enough income to take care of all of your needs, your travel. In my case, travel is my my biggest expense. Okay. So, that you can take care of all that and still maintain your capital or grow it over the course of a year. That's income independent.
Nice. I like the way you put it. It's one thing to have a lot of money to do different things. It's another thing to have a lot of income, in this case, cash flow, to support your needs and to do whatever you want to do.
It's like, let's say you had $10 million worth of gold in a safe in your garage.
Yes.
You're worth $10 million, but you're working a 9-to-5 job and everything else is coming out of your normal cash flow. You're not getting anything. You're not getting any income from that $10 million. You have to sell a gold brick if you want to do something else, even put an addition on the house. So that's the idea. There are assets and there's capital and there's working capital. Working capital produces income.
That's why the cash flow statement is one of the single most important statements every company looks out for, because at the end of the day,
every company, right?
Cash is king.
So what you just said,
yes.
Cash is king. Think about it. Every company on Wall Street, cash flow, most important. Profits, most important, right?
Yeah, the accounting profit doesn't necessarily mean cash flow. So at the end of the day, we always go back to cash flow because, yes, we've seen the accounting profit.
Okay, you're right. Okay, so it's cash flow. It's cash flow that's important. So here these guys are, and they're wanting you to invest in all these wonderful companies with this great cash flow, but they don't encourage you to have any cash flow of your own.
That's true.
They just put you in any type of securities. Don't pay any cash flow at all. NVIDIA doesn't pay a dividend. But if you tell a guy, I want to go buy some NVIDIA, sure. Berkshire Hathaway, I don't think pays a dividend. I'm not sure of that one. But Microsoft, I know, pays less than 1%. But that's fine, even though Microsoft probably had NVIDIA, maybe, but Microsoft certainly has adequate cash flow. But they don't want you to have adequate cash flow. It's dysfunctional the way they manage portfolios today.
I think at the end of the day, people are just looking for value, equity value, and the increase in that, as opposed to the cash flow, because they might not necessarily need the money at the time. So they just hold those shares, and when maybe they need some cash, to sell off some of them.
Yeah. If it's a good time. But what if it's in March of 2020?
Yeah, that's true.
Or in 2008 and 2009, or during the dot-com bubble. It happens. I had college buddies who couldn't retire because it was 65 or so, 25 years ago. They were getting in their late 60s, and they couldn't retire because their 401ks went down so much in the financial crisis. So income, like you said, it cash is king. Income, and I'd say income is sitting in the chair right next to them.
So I know in your books and in your communities, you've developed key concepts such as IGVSI, QDI, PT, and Smart Cash. Which of these should every income-seeking investor understand first? And can you just break down the code names, because a lot of our audience is there.
Okay, the code. Well, the IGVSI was the investment grade value stock index, and that's what I used for stocks when I was back in the 80s, when I was still using individual stocks. And I mentioned before how we developed this index of the companies that were New York Stock Exchange companies, paying dividends, profitable, and so on. So they met all these quality requirements. So they went into this index. Now, that's what that was all about. The QDI plus PT are the 4 great risk minimizers that an investor uses to minimize the risk in his portfolio. Only invest in high quality companies and develop a way to determine what you think is a quality. Like we said,
What's QDI
investment
plus
grade.
PT? What does it stand for? Quality?
Quality is the Q.
Oh,
Diversification, all the different sectors and types.
Income.
Production, everything has to produce income for you. And profit taking
PT.
is the PT. So you have to take your profits and develop that second stream of income. Now, smart cash, and right now you could say it's an environment where smart cash. Remember I talked about back in the day when interest rates were low and you didn't want to take hundreds of $1,000s of profits because money markets were zero and smart cash was gone. Smart cash is when you take a 10% profit and it's sitting in a money market fund earning another 5 or 6%. That used to be in the days before the financial crisis, but right now it's around 5%. That's not bad. If you just made 10%, you just made 5%, having it sit there making something is okay. So it's smart. But when it's 0%, like it was for years, coming, after the financial crisis when interest rates were so low, smart cash didn't exist at that point because you'd have all that money, it would be just sitting there doing nothing. So you wanted to get reinvested as fast as possible. But that's what smart cash was all about.
So every income investor should understand all of them. That's what you're saying.
Yeah, any investor should know about quality, diversification, and income. Those are the 3 important things. They should look at profit taking, understand that it creates a second stream of income over and above the distributions you're receiving from your investments. And understand that there are literally hundreds of different securities that are of a good enough quality to use in your investment portfolio. But you have to be the one that defines the quality, not your broker. You set the quality guidelines because his quality guidelines are never going to be profitable company. They're never going to be income producing company and so on.
Nice. Like the way you advocate for people standing up to the brokers, because if you don't say anything, they just give you whatever they want to give you and maximize profit off you anyways. So what's the biggest, so far in your experience, what's the biggest lesson you've learned in the investment world, and what legacy do you hope to leave with the body of work?
Well, the legacy I think is pretty clear.
Income.
Income is we want to see the investment world understand what you understand, that income or cash is king, and it's your duty to your clients to produce income for them and not necessarily just to grow their market value. There's a reason why they don't encourage people to take profits, and that's because of legal reasons. If I had 100% profit in Microsoft and my broker told me to sell it, to take that profit, Microsoft went up another 100%, I could sue them because the broker should have known somehow.
Microsoft is going to eat
the
another
legal
one.
system thinks that being an investment expert means you can predict the future. Of course, we all know you can't, but still in all, that's the reason that they don't initiate profit taking as much as they should. So you, the investor, has to say to them, I'm not comfortable with having a 60% profit in something because we can have a correction. I want you to take the profit, and then he'll do it for you. But you pretty much have to take the incentive.
So what legacy are you leaving with your body of work?
That's what the legacy is, to have a financial community that is focused on income production and not just on growing
I like the
market
fact you're
value.
already living
That's what I.
that's your legacy. So how can people join
Well, I'm
join
living it
your
out,
community?
but yeah. For me, and for a bunch of people, for 450 people, or the maybe half of the 7,000
Yeah.
that have bought the book, are moving in that direction. I think that's great. We got a long way to go, but I have a community called the Retirement Money Secrets (RMS) Income Investing Community, and it's on the school
Mm.
platform. And you can join. Its links to it are in the book, actually, and on my website, which is theincomecoach.net. They can find ways to get it. You really don't want to join it if you haven't already started to read the book, because otherwise you'll just be blown away by, you won't appreciate the conversations within the group as much as you will if you've read the book. And it's only, you can get the book for less than $10.
I'll put the links to the book and the links to the website so our viewers can just go there and check it out. So this is the second round of the questioning, and this is called the firecracker segment. So I just punch at you with a bunch of questions, and you punch right back at me with the first answer that comes to your mind. So drum roll.
Okay, fire
Here we go.
fire away.
What's one mindset shift that changed everything for you in business?
Well, my business has always been finance, and it's always been around the market one way or the other. Even when I was working for this life insurance company, I was in their pension investment department. So it was always there. I think the idea of taking
Okay.
profits, understanding the cyclical nature of the markets and the stocks within them, knowing that they go up and down and up and down. I think the biggest flash or aha moment would have been, why don't we sell them when they go up and buy them again when they go down? The same companies over and over again. And that's when I first established my 10% profit taking
Yeah.
target for the individual stocks that I was trading in my 20s.
Nice. So what's the next question? What's one investment principle you wish everyone learns in school?
I wouldn't even make it that simple or easy for them. What we need in school, even in high school, is that they teach the basic fundamentals of investing and of interest rates and what they are, what they mean, and how they impact securities. There are people out there who have a 401k that don't even know they're invested
Yes.
in the stock market. They don't know the difference between a stock and a bond, much less a CLO or a BDC or a
I've
REIT.
never even heard of it before
They
because it's
just
like, oh,
no,
that's just financial jargon. I can't be bothered.
just financial jargon that your life depends upon, because you
Yes.
need money to live. And if you know about money, it's more likely that you're going to know how to use it. It's got to be started soon. It's got to be started in high school.
So
And that's
the next question: bull markets or bear markets? What's your favorite and why? I think you
okay.
say both.
I gotta go along with the crowd.
The bull.
I like bull markets better because I can take more and more profits. Not because my growth in market value, which runs alongside, but because I can take more and more profits. But I also love bear markets because they provide opportunities to buy things at lower prices and higher yields. So I love the bull market more. I like
I
bulls
like the
more
way
than
you
bears.
expounded on the opportunities on both sides of the divide because an average person would just go for
Both are
an average person
opportunities.
would just go for the bull market like, oh, that's where things are going up. I'll stick to that.
Right. And I will feel wealthy even though I don't take any action to improve my level of income. That's what the
Yes.
average guy will say. Yeah.
So you had to start all over again and you have just 100K in your portfolio and you have to just that 100K to start building your retirement portfolio all over again today. what's your first move?
Well, my first move is to put it all into closed-end
Okay.
funds. And at my age, I would put probably 70% of it in an income-focused bond, preferred
Sure.
stock, that type of closed-end funds, yielding right now about an average of over 10.5%, and the other 30% in closed-end funds that are invested in the stock market, and they're also yielding just over 10%. So I would be creating a 10% income portfolio that would have every position in it. I would probably have about 45 to 50 different positions, and as each one reached profitability, I would take that profit and add a different position and just keep doing it again. And by the end of the year, I would probably have $115,000.
Wow. I love the way you put it. And just to pick your brain, when you're not allowing yourself to be picked, doing coaching, private coaching, and helping people multiply their income, how do you unwind? I know you said you love traveling.
We travel. We do probably two major trips a year, between 2 and 3 weeks. Like we were in Europe for almost the whole
Oh,
month of
and you
April
didn't come to London.
this year. And no, but next year we will be getting on a boat in
Hey,
London, a
so
Viking boat
I'll be
in
happy to host
London,
you. We'll have another
and we're going to we'll probably
nice.
spend a night or two there, and then we're going to take this ship up to the
Okay.
Shetlands, up into the islands, up on the top of, and then we're going to finish up going to
Well,
Bergen, I
you
think,
already
in
have your trip
Norway.
for next year planned out.
But that's next year. But we're also in October. We're going to be going to India by way of Dubai. We're going to spend a couple nights in Dubai and then go to India for almost
Nice.
3 weeks. So October will be out. So that's what we do, and we play golf
That's
once a week or
chilled.
so,
You're
and
you're maximizing your
walk.
retirement, and I'm loving it for you. Thank you so much for joining us on the podcast today.
Well, thank you. Thanks for having me. It's
Yeah,
been
really appreciate that. So there you have it, guys. You can start building your retirement wealth right now. Steve has already broken down everything, and he has his book. Steve, talk about your book for a minute.
Retirement Money Secrets. We talk about the things you and I were talking about, the working capital idea, the mental mind shift going from market value to an income focus, and how you get there, and the risk minimization using quality diversification and income, and the techniques of profit taking. And it also talks just in general about markets and interest rates and risk, and just all of the fundamentals, the education they didn't get in school that we were talking about they should get in school. This is the education you didn't get, and then how to develop that income focus that will get you into retirement or anything
Yes.
you want to do more
Thank you so
safely.
much for that breakdown, Steve, because I feel like this has been like a masterclass and I've learned so much. I feel like I've drawn a lot from you, and I'm really grateful for you sharing your time and your life with me because the SI unit for measuring life is in terms of time. And you've basically shared your time with me, shared your time with our viewers, and we are indeed grateful. Thank you for sharing this secret with us. And we'll definitely get your book and we'll get on the coaching community because we have to prep for retirement. One day, one time, we're going to retire.
Right.
So we need to make the most of it. We can't be retiring and be stuck looking for people to care for us.
Yeah, you might even find some interesting guests for
Yes.
your
And probably
podcast in the
investors,
community.
people that might want to invest in my business. Who knows?
Who
Yes.
knows? You might.
And so, guys,
There are certainly some big people in there.
and
So
there we have it, guys. It's been
okay,
another amazing episode of Bricks and Banks with Steph. Let's continue to turn knowledge into action and bricks into banks. So we meet again. It's been an amazing time with Steve Selengut, and this is Steph signing out. Cheers.